Good afternoon. This is Brian Dewhurst with Uncommon Wealth Partners bringing you your market update and Bitcoin briefing. Headed into September year-to-date, S&P up 8.99, NASDAQ 16.49, Dow Jones 6.96, gold down 9.15, a lot of niners in there. Bitcoin as of the 27th was also down 53.83%. Wanted to show you some macroeconomic stuff. Wanted to talk about interest rates. I promised you guys that in a previous video. I know this is a little unclear, but this is the interest rates in the United States back to 1790, so very long-term chart. I want to key in on these kind of peak to trough patterns, and we're coming off a peak. We're now in the trough, and it looks like rates are ready to reverse back up. And really for the last 30 to 40 years, we've been in a decreasing rate environment, which has helped bonds act more like stocks. And our retirees facing the next 40 years might be in a different interest rate environment. We will see. But wanted to kind of just highlight this. This is the federal funds rate. This is the rate that the Federal Reserve uses for interbank dealings. This is the shortest duration or term for an instrument that kind of tracks interest rates. And so you'll hear like 10-year treasury or 30-year mortgage or 2-year treasury. Well, the Fed funds rate is really kind of like the interbank rate, and it's kind of more factored on a shorter term basis. And so you see this rate was at zero for several years and is now coming off the bottom as the Fed raised rates this past week. So this is the 10-year treasury chart. You can see the double top here. Potentially forming, and as rates go down on the 10-year, meaning people are buying the 10-year, more demand, the yield goes down, and so we're seeing a potential double top in the yield. We'll see here if this coincides with a reduction in the stock market, or if the stock market can continue to make higher highs here. But wanted to show you that the 10-year Treasury is looking a little bit exhausted on this chart. Mortgage rates are approaching a 7-year high. The 30-year mortgage rates have been historically low. Sub 5 to 6% is historically super low. Got down to about 3.5% a couple times in the last 5 to 6 years, and now we're pushing back up towards 5%. Had a client looking at buying a new home. They were quoted 4.75 by 4.85, depending on the lender. So yeah, mortgage rates are going up, and that has a dampening or hampering on home prices because money is more expensive, and it reduces the ability for home prices to continue to go up. So we'll see. It's kind of something we're watching. And in that, we'll see the correlation to this median sales of home prices in the United States. You kind of see the financial crisis and how home prices went down considerably. And we've kind of gotten a lot back in the last 7 to 8 years. And even that, you can see those prices are sharply coming down. And a lot of the articles I've read, when you look at like the mega homes, like homes over $50 million, that type of thing, those prices are correcting dramatically, double digit, like over 20% reduction in price. And now we're starting to see headlines on the coasts, California, Florida, that type of thing, where prices are starting to pull back. Things appear just to be a little exhausted. And a rising rate environment is gonna curtail that price appreciation in real estate. And something I think you guys need to be kind of aware of as you're looking at making real estate-based decisions. So monthly supply of houses, this is another data point that a lot of real estate agents use more in the local area. This is national, so it's obviously going to vary market to market. But you can kind of see here in the financial crisis, there's a massive buildup of homes. A lot of the home builders went bankrupt. There's an oversupply of homes because there was cheap money. And you can see that the supply of homes got up to 12 months. Corrected down to almost 4 months supply, which is, you can see down here, is really the low point for the last 40 to 50 years. And so we're trending nicely here up to, about 6 months of supply. So still healthy, but definitely on an uptrend. So we'll watch that. I thought this was an interesting chart. I grabbed this from somebody else as well. This is lumber prices and lumber future contracts. And lumber prices peaked at $640 and have now pulled back to about $350. And so that's a massive decline in lumber prices. And, I heard a lot of people quoting that, building a home right now has been the most expensive it's in history. Interesting. That's what we would call like a leading indicator, meaning that's going to drop first before you see the drop in like home prices, maybe, or the drop in new home sales, or even the stock market. And so lumber is one of those things that's out in front. And as real estate is one of the biggest industries to our economy, just because of the borrowed money, the price impact, the wealth creation that comes from a rising real estate market across the country, real estate agents, home people, mortgage people. There's just a lot of our economy tied up in the health of the real estate sector. And so this lumber chart is a leading indicator of the health of what that might be in its future direction. So something to watch. Now we go into the S&P 500, what we normally look at. The S&P 500 is not showing any signs, of a pullback or collapse right now, like we're seeing in a pullback potentially in interest rates, or this pullback in housing. And so housing is typically first, and then the stock market follows later. So something we're definitely keeping an eye on. This is a daily chart, so pretty zoomed in. That's why there's all these red arrows. But everything looks kind of the way we'd like to see it typically, for the market to continue to make higher highs. But I do think we're hitting some sort of a little bit of an exhaustion point here. So we're trying to keep an eye on things closely. When we zoom out to our monthly view on the indexes, still again look really healthy. All the indicators are where we would want them to be. Blue candles, we got 6 green dots, and we're making new teal bars down here on the momentum. So that's looking strong. I wanted to show this, though. This is kind of a different way to look at things in the past that have been a tell, maybe that the stock market is overvalued. This is the Russell 3000, whereas the S&P 500 is 500 stocks. The Dow Jones is 30 stocks. This Russell 3000 is considered a better general gauge of the overall market, with 3,000 companies. And in this, it's saying companies that are trading 10 times revenue, which is super aggressive. Typically you would see a company sell for, like, if you're going to buy a private company, you might pay 4 to 6 times sales. And that has to be a really good operation, really well run, all those different things. So to see a company trading 10 times revenue, not even profit, revenue, that's pretty substantial. And so you kind of see back here in the tech bubble, got up over 400 companies, over 10% of the index was trading above 10 times revenue. And so now we're approaching this level of 350, over 10% as of now. 400 would be almost like 15%, I think. So anyways, doing some rough math in my head. But yeah, it's approaching pretty near all-time highs other than the tech bubble. So something to definitely watch. And then on this same vein, looking at the Microsoft, Intel, Lucent, Cisco, Oracle, Dell, and their makeup or their market cap as a percentage share of the S&P 500 back in 1998, almost peaked at 18%, with just those handful of companies making up that much of almost 20% of the S&P 500 market cap. The S&P 500 is a market cap driven index, and so the bigger the market cap of certain companies, the more that performance can have weight on the overall index. And now we see that now current time with the FANG stocks, which is Facebook, Apple, Alphabet, Netflix, Google, and Microsoft, I believe, approaching again an 18% market cap as an overall percentage of the S&P 500. So definitely looking like some time to be cautious. Here's another just set of headlines we wanted to include. Starbucks plans corporate shakeup and layoffs starting with senior execs. Novartis to cut 2,000 jobs amid revamp. Under Armour laying off 400 people. And Verizon launches an early retirement program to trim workforce. We actually have several clients that work for Verizon, so we've actually heard this story ourselves. And they've offered an early retirement package to their entire workforce in the United States that's been there longer than 30 days. So pretty much everybody. So we're seeing some shakeups in corporate America. We're seeing some exhaustion levels in real estate, which can be a leading indicator, and we're watching things closely in the market. So again, hope this information was valuable. Hope, if you have questions, please reach out, and we will have another video for you mid-month. Thanks, everybody. The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.